there's no question that trade can be an act of war. And I think it's led to bad things. Just the attitudes it's brought out in the United States with 8 countries with nuclear weapons, including a few that are what I would call quite unstable. I do not think it's a great idea to try and design a world where a few countries say, ha, 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 we've won, and other countries are envious.
What if I told you that the biggest threat to your investments today isn't inflation, interest rates, or even the stock market itself, but something far more dangerous? Warren Buffett has just delivered one of his most urgent warnings yet, highlighting a hidden risk that most investors haven't fully grasped. Trade wars, often dismissed as political noise, could actually be laying the groundwork for global economic instability, and even geopolitical chaos. In this video, we'll uncover exactly why Buffett is sounding the alarm, explore the shocking historical lessons behind his concerns, and reveal the hidden ways these trade disputes can directly impact your financial future. Make sure to stick around till the end of this video because what you're about to learn might completely change how you think about investing in today's uncertain world.
I think you can make some very good arguments for the fact that balanced trade is good for the world, and the more balanced trade there is, the better. It will continue to be better for cocoa to be raised in Ghana and coffee in Colombia and a few things. And over time, the American industry has gone from being an agricultural country. This was nothing but an ag country. I mean, virtually. And that was only 250 years ago. And we have become a very industrial country, and we did not want to make that a situation, in my view, where we ran greater and greater deficits, building up greater and greater debts against the country. So I designed this import certificate thing, which Charlie thought was a little Rube, too much like Rube Goldberg. It's gimmicky, but it's certainly a lot better than anything I think than we're talking about now. And there's no question that trade can be an act of war. And I think it's led to bad things. Just the attitudes it's brought out in the United States. I mean, we should be looking to trade with the rest of the world, and we should do what we do best, and they should do what they do best.
Following Buffett's stark warning, it's crucial to understand exactly why he's so cautious about tariffs. Buffett isn't just worried about higher prices or immediate disruption. He's concerned about what economists call the second-order effects. These are hidden domino effects that ripple through the economy, often quietly but with long-lasting consequences. Think of tariffs as hidden taxes. During the first U.S.-China trade war between 2018 and 2020, these hidden taxes hit American wallets hard. Take Berkshire Hathaway's own paint company, Benjamin Moore. The tariffs made imported steel more expensive, significantly driving up the cost of their paint cans. Across the economy, tariffs became a hidden burden, quietly inflating prices everywhere from supermarkets to hardware stores. And the numbers aren't trivial. According to the Tax Foundation, tariffs imposed in 2025 will add roughly $157 billion to the government's revenues. Sounds good, right? Well, not exactly. That's essentially a new, hidden tax of around $1,200 a year for every American household. Some analysts now expect this tariff tax could boost inflation by up to 2.5% in 2025 alone. But higher prices are just the start. Tariffs create uncertainty, and uncertainty freezes investment. Imagine you're planning to build a factory, but knowing that overnight your cost could suddenly jump by 25%. Would you still invest? Most companies wouldn't. We saw this play out during the previous trade tensions. Businesses hit pause on new projects, slowing economic growth and costing American jobs. According to the World Bank, global growth in 2019 alone was at least half a percentage point lower because businesses everywhere grew hesitant and cautious. And it wasn't just America. Manufacturers worldwide delayed equipment upgrades and expansions, unsure what the future held. Fast forward to today, and history is repeating itself. An S&P Global report recently warned the lack of clarity on U.S. trade policy will delay investments, once again injecting uncertainty into global markets. The next issue with tariffs is the currency volatility they create. which is perhaps the sneakiest and most dangerous effect of trade wars. When the US puts tariffs on Chinese goods, China doesn't just sit back, they often respond by strategically weakening their currency, the yuan. It's like a chess game, but with national economies at stake. Let me explain how this works with an example. Imagine you're in the US and you regularly buy air purifiers from a Chinese supplier. Each one costs $100. Then the US government adds a 10% tariff on Chinese imports. That means you now have to pay $110. The same purifier just got more expensive. But now China does something in response. It lets its currency lose value against the dollar. Why does that matter? Because now your dollar can buy more in China. So even though the air purifier still costs the same amount in Chinese money, it ends up looking cheaper in US dollars. Why? Because the US dollar has gotten stronger compared to the Chinese currency. It's a bit like going on vacation. Let's say last year you went to Europe and exchanged $100 for 80 euros. But this year, because the exchange rate changed, your $100 gets you 90 euros instead. You didn't bring more money, but suddenly everything feels cheaper because your dollars now go farther. That is exactly what happens when a country weakens its currency. If a Chinese air purifier still costs 700 yuan and $1 now gets you more yuan than before, that same purifier might now only cost you $90 instead of $100, without China lowering the price at all. So when the US adds a 10% tariff, bringing the price back up to around $99, it feels like nothing really changed to the US customer or the Chinese supplier. The tariff gets canceled out by the currency drop. This might seem clever, but it's actually very dangerous. When countries start using currencies as weapons, global financial stability takes a hit. Between 2018 and 2019, the Chinese yuan fell 12 to 14% against the dollar, offsetting tariffs. But this triggered instability in other Asian currencies, prompting neighboring countries to consider their own currency devaluations. That's how a trade war can quickly escalate into a currency war, with no real winners, only escalating uncertainty. And for Buffett, that kind of tit-for-tat instability isn't just bad policy. It's a real threat to global prosperity and long-term investing. And when investors sense uncertainty, they act swiftly, moving money around the globe in a heartbeat. Typically, when markets get jittery, investors pull their cash from riskier emerging markets and park it in safer havens. Traditionally, U.S. government bonds or stable currencies like the Swiss franc. But 2025 brought a troubling new twist. Initially, money flowed into the U.S. as usual. But as tariffs intensified, investors got nervous about America's economic future and began pulling capital out of U.S. assets too, even traditionally safe government bonds. Here's why that matters. U.S. government bonds, also known as treasuries, are normally considered the safest investments globally. But as investors sold off these bonds, their price dropped. And when bond prices fall, treasury yields, or the interest rate the government pays to borrow money, rises sharply. Suddenly, the U.S. dollar had to offer higher interest rates just to entice new investors. It's like your mortgage rate unexpectedly jumping overnight. Not because you borrowed more, but simply because lenders suddenly trust you less. Given America's massive deficits and its $36 trillion debt, rising interest costs can have devastating effects. Money that could have been spent on infrastructure, healthcare, or education must now go toward higher interest payments, essentially wasted funds that provide no new benefit. Buffett has warned about this scenario for years. He believes that when a nation starts spending increasingly large portions of its budget just paying off debt, particularly debt driven by self-inflicted wounds like trade wars, it severely undermines long-term prosperity and stability. All these interconnected consequences, hidden price hikes, frozen investments, unstable currencies, and rising borrowing costs, ultimately lead to a world that is not just economically unstable, but politically volatile as well. And in today's tense geopolitical climate, Buffett's concerns couldn't be more justified. Let's listen carefully to exactly why Buffett believes we're standing at such a dangerous crossroads.
With 8 countries with nuclear weapons, including a few that are what I would call quite unstable, I do not think it's a great idea to try and design a world where a few countries say, ha, 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 we've won, and other countries are envious. The main thing to do is not use trade should not be a weapon. And the United States, we've won. I mean, we have become an incredibly important country, starting from nothing. 250 years ago, there's nothing been anything like it. And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done. And I don't think it's right, and I don't think it's wise. I do think that the more prosperous the rest of the world becomes, it won't be at our expense. The more prosperous we'll become, and the safer we'll feel, and your children will feel someday.
Buffett's warning here isn't subtle, and it's not just about economics. It's about the painful lessons of history. When Buffett cautions against using trade as a weapon, he's speaking from a deep understanding of what can happen when countries let pride and short-term interests cloud their judgment. Let's rewind to 1930. The U.S. had just passed the Smoot-Hawley Tariff Act, aiming to protect American jobs during the Great Depression. On paper, it seemed like a good idea, but reality quickly proved otherwise. Other nations immediately retaliated, imposing tariffs of their own. What started as a policy to protect jobs turned into a global economic showdown. World trade didn't just slow, it collapsed, plunging by nearly 2/3 from 1929 to 1934. American exports plummeted by over 30%. Factories shuttered, unemployment soared, and resentment against America spread around the globe. But it didn't stop at economics. The world became increasingly fractured. Countries turned inward, nationalism surged, and economic hostilities paved the way for far darker outcomes. Historians today see the 1930s tariffs and the global backlash they triggered as something that contributed to the rise of tensions that eventually erupted into the catastrophe of World War II. Buffett isn't sounding the alarm lightly. He understands history's patterns deeply, and he sees dangerous echoes today only amplified. Back in the 1930s, the world was volatile but didn't yet possess the terrifying capacity to destroy itself in an instant. Today, things are different. 8 countries now have nuclear arsenals, and Buffett himself pointed out that some of these nations are worryingly unstable. That's why this warning matters so much. When major powers weaponize trade today, the fallout isn't confined to economic pain. The risks are geopolitical and potentially catastrophic. Buffett isn't just speaking as an investor watching GDP numbers or tariff costs. He's speaking as a careful student of history who knows just how quickly economic hostility can escalate into geopolitical chaos. This time, as he makes very clear, the stakes aren't just economic, they're existential. So how do you protect your portfolio when the world feels this unstable? Buffett's strategy hasn't changed. Ignore the noise. Focus on buying great businesses you understand at a discount to their intrinsic value. It sounds simple, but it's not easy, because finding great businesses is hard. There are over 55,000 publicly traded companies globally. How do you find a few that are truly worth owning and trading at a price that actually makes sense? And once you do, how do you know you haven't missed something? That's where most investors struggle, not because they lack conviction, but because they lack time. That's exactly why we created Compounders Clubhouse Research. It's a premium stock research service for long-term investors who want to invest with clarity, not confusion. Every month, we send you one high-conviction stock idea, backed by 40-plus hours of research, distilled into a single, actionable deep dive. No fluff, no hype. Just investment ideas rooted in the frameworks of Buffett and Munger we've been teaching on this channel for over 5 years. We're launching in a few weeks, and the first 250 members will get a massive discount on the service, locked in for life. Waitlist subscribers will get early access before we open to the public. So if you want first dibs on a founding member spot, this is your chance. Join the waitlist now at the link in the description. And when you do, we'll also send you a free copy of our guide, Charlie Munger's 11 Mental Models to Beat the Market. These are the same frameworks Munger used to outperform, and now you can use them to sharpen your own thinking. Hit the link in the description, get the guide, join the waitlist. Thanks for watching, and I'll see you again soon.